Hello, welcome back to the show. So in today's video, stocks are going crazy again. So in today's video, we'll be covering a few things. We'll be covering stocks that are going crazy today and when I'll be buying them. I'll be talking about analysts as well, some undervalued strong mode stocks, as well as some questions that you guys have left me in the comment section below. So let's look at the S&P 500 today. The S&P 500 today is in bright green. So you have companies like Apple going up 6%, you have Amazon going up 8% in one day, Google at 3%, Meta at 7%. Basically, all across the board, you will see green. The only ones that are red are your consumer defensives and all your different other defensive companies over here, as well as United Health as usual. Stocks are going crazy because US and China, they basically made a deal to reduce all your different tariffs. And this is the start of the de-escalation between US and China over here. So these are the tariff rates that both countries have placed on each other. So US over here, they hiked it all the way until 145%. That was when we saw the bottom in the market. And then currently now we're back to around 30%. So this is quite a substantial drop from its highs. Same thing for China over here. China went all the way up to around 125% and now it's back down to around 10% tariffs on US goods over here. So the markets now are forward looking. The markets are now looking for two things to continue going higher. So all this tariff news, they are all old news already. The anticipated tariff deals that the markets wanted in the form of the deals with the Chinese as well as the deals with all the different European countries, including the UK itself, are already priced in. So what the markets want now are two things. The markets want rate cuts as well as a strong, resilient economy unaffected by tariffs. So all your different tariffs that were placed in Q1 itself, none of the effects are felt yet. They will likely come in Q3 and Q4. And if we see weak economic data like back in 2018 towards the end of the year, and with a high stock market valuation today, we could see sort of like a pullback after this bull market run over here. So the markets are now in a new bull market. So the markets are by definition at the start of a new bull market. So we're currently now around 20% up from the bottom already. So we bottomed out at around 4,800. Currently now we're trading at around a 5,800 over here. So by definition, we're at the start of a bull market. And now analysts are basically flipping to bullish over here. So here are some of the stocks that I'll be looking to add in the near future if I get another opportunity again. So the ones that are highlighted are the ones that I've been heavily adding over the past few weeks or so. So United Health over here is a company that is extremely undervalued right now. My fair value for United Health is around $480. Currently now it's trading at less than $380 over here. So you get a quite large margin of safety over there. Google also, so my fair value for Google is at around $200. Currently now it's trading at around $160. So I still view this company as extremely undervalued. ASML as well, my fair value for ASML is at around $750, which is where it's trading at today. A few weeks ago in April, the stock was trading at below $580. That was when I was heavily piling into this stock. Currently now I have quite a sizable position in ASML, so I won't be adding this one in the near future. So I'll be adding this one only if it drops below $600 again. So the next portion over here, I'll be talking about some analysts. So Mike Wilson over here, back in April 7th, literally at the stock market bottom, he said that investors should brace for another 7 to 8% drop in the S&P 500. See, it's Morgan Stanley Mike Wilson over here. So on April 7th, I believe the S&P 500 was trading at around 5,000 points. And then he predicted that the stock market will drop all the way until $4,700. He sold a lot of his positions and he told his investors that were under him to basically be bearish and to sell the stocks and de-risk in the markets over here. And currently now he's flipping bullish. So this is what he recently said about his S&P 500 target over here.
With a year-end target of 6,500, we were very much in the camp.
Year-end is 6,500.
Yeah, that was always the case because we viewed first half tough, second half actually quite good. We did not lower our year-end targets in this, sort of interplay that we've been experiencing because we felt like it was getting fairly cheap. We never know the timing on that. 6,500 is still our target. We just don't know if it's December 31st or it's the first quarter. It could even come sooner if things really, play faster than what people are anticipating. But yeah, I think our 12-month targets are very much intact. The 51 to 55 to 60 100 was always a first half range. And so our view now, I feel better that the second half now from a rate of change standpoint can be better than what people are expecting because the first half was actually worse than what people were expecting.
So for all your analysts over here, you should be listening to their analysis, not their predictions, because they often flip-flop and it's always the noise that will affect your decision making over here. So whether or not you think your decision making will be affected by them, you will definitely still somewhat be affected by them subconsciously. And that's why for analysts like, for example, Mike Wilson over here, saying the S&P 500 will drop to around $4,700. And then a month later, flip-flopping after the S&P 500 has rallied around 12% from its lows already. In fact, today, it's around 20% off its lows already. I think all these are just noise. should block them out, listen to them for their analysis, not so much their predictions over here. So next portion over here, I'll be talking about why a strong moat is important. So a high quality business will be able to grow into its high valuation, but a low quality business never will. So what defines a moat? So a moat is classified by these few things over here. So number one, high barriers to entry and minimal competition. So you want companies that sell products that are not easily made. So for example, let's say if we were to compare an oil company that sells oil versus another company like for example S&P Global selling their credit ratings, no other company will be able to sell S&P Global ratings because it is attached to the brand itself. But every single company on this planet Earth can just sell oil. All they need is just a supply of oil. So what you want for your companies is you want high barriers to entry and minimal competition. That's one of them. The second portion over here is a monopoly on IP. So an IP is, for example, a company like ASML with their lithography machines, their EUV machines. No other company is able to create EUV machines at such a high scale as compared to ASML over here, and that is the competitive advantage that ASML has, and that's why it has around 80% market share of the entire lithography segment over here. Next portion is high switching costs. So high switching costs is similar to what I talked about earlier as well, which is your S&P Global, for example. So S&P Global, what they do is they charge a percentage of every single bond that's being rated, and no companies are able to switch out of all these S&P Global ratings, simply because S&P Global has such a wide brand name and it is the language in your credit ratings already. So companies lose more money trying to switch to other credit raters instead of S&P Global and Moody's. So that is high switching costs over here. Another example of companies with high switching costs are your software companies. So for example, Microsoft, Salesforce, all these different companies, they require high switching costs because imagine, let's say you have a corporate company trying to switch from Salesforce to a competitor like Oracle, for example, it will be extremely troublesome for them to do so. Last one is network effects. So network effects include companies like Meta, Google, all these different companies, they have incredible network effects. More people leads to more people using their products, and it is just a vicious loop that will generate incremental profits for these companies over here. So this is why a strong moat leads to great return. So this is from Morningstar over here. They had a Morningstar White Moat Focus Index, and the Morningstar White Moat Focus Index has widely outperformed your S&P 500 as well as all your other indexes over here. So clearly a white moat is extremely strong. It leads to outsized returns over time, and that is what you should be investing in when it comes to owning stocks. So here are some white moat stocks that are currently undervalued. The first one over here is United Health. So United Health is a company trading at around a 16 times earnings, and currently now year to date is down around 20%. Pre-earnings is down around 35 to 40% already. So it's quite drastic for this company. I've been adding into this one slowly. I'll be looking to add all the way down until $360. That will likely be my last entry for United Health over here. But this company, it has a decent size moat, although it is not unbreakable, but I view it as a white moat company over here. Next one is TSMC. So this one might come as a shock, but for TSMC over here, it is an incredibly wide moat business simply because no other company has the technology that TSMC does, and no other company can do it at such a wide scale as compared to TSMC over here. So for TSMC over here, it deserves an extremely high multiple simply because of the monopoly that it has. But currently now, TSMC is still trading only at a 22 times earnings. So TSMC over here, if it was not placed in Taiwan, it will definitely command a much higher valuation over here. In fact, if you're in the US, it will likely be upwards of 30 times earnings already. So for TSMC over here, being one of the front runners of AI, I still view it as undervalued. It deserves a higher multiple, but I won't be investing into this one simply because it is situated in Taiwan. Next one is Google. So Google is a stock that's currently trading at 18 times earnings. And when you have a Max 7 stock that is trading at below 20 times earnings, that is when you should be starting to look over here. So for Google over here, despite the beats in earnings, almost for the past few quarters or so, this company is still trading at a discount as compared to the market. So the markets are now trading at around a 25 times earnings. Google is trading at 18 times earnings. So when you have such a great discrepancy between Google's valuation as compared to the market, you buy Google because Google is a high quality business. It is probably the top 10 highest quality business in your S&P 500, and it is trading down simply because of bad sentiments right now, and that's why I've been adding into this one as well. Last portion, I'll be talking about some questions that you guys have left me over here. So the first question over here, it says, what's your view on investing in Bitcoin? So my view on investing in Bitcoin is this. Bitcoin is an asset that people say, but Bitcoin is not cash flow generative. So when it comes to owning assets, you want to own assets that can generate you cash flow. So for example, a property will give you rental income. Stocks can grow intrinsic value because stocks, they sell product and then there's cash flows in the company itself. But for Bitcoin over here, the only way for you to make money out of it is to sell it to someone else that wants the Bitcoin at a higher price than you paid for. So for Bitcoin over here, if you own the entire world supply of Bitcoin and with no one to sell it to, then there is no point in holding Bitcoin at all. It is similar to gold, but gold has a different story because it is government backed. So for Bitcoin over here, although it is a currency that won't disappear over the next 5-10 years or so, simply because of the clout that's built around it, I don't view Bitcoin as investing. I view Bitcoin as more of a speculation, and that's why I wouldn't be dabbling into it. And Warren Buffett also previously said that if people offered him $10 to buy the entire world supply of Bitcoin, he can't buy it as well. He won't buy it simply because there won't be anyone for him to sell it to. Because the only way for him to make money is for someone else to buy it at a higher price from him. And it is not able to generate any form of cash flows over here. So for Bitcoin, simple story, I won't be investing into it. I won't be buying any sort of Bitcoin over here. Next question. Hi Guan, great insights as always. Have your thesis now changed on UNH due to US admin initiatives to cut drug prices from 80% to 30%? So if you haven't seen the headlines, this is the headlines over here. So Trump signed sweeping executive orders to cut US drugs prices by up to 90%. So what Trump is basically trying to do is he's trying to lower all the drug prices in the US itself. And if you're to compare drug prices in the US itself as compared to all the different other countries over here, drug prices in the US itself can cost up to 10 times more than, for example, a country in Europe. So what Trump is doing over here is good for the people in the US, but it could be bad for all the different pharmaceutical companies, like for example, Novo Nordisk, because Novo Nordisk, they make most of the money in the US itself. So this is my reply to his comment over here. So there are two arguments to this. Lower drug costs means higher margins for healthcare insurance companies. After all, the claims for the drugs typically make up a large portion of their cost of goods sold. So for all the different insurance companies over here, if the drug prices come down, then that means that they'll have to pay lesser when people claim their monies for all the different drugs, and that could lead to margin expansion in their insurance business. But there's a counter argument to this as well. So the other chain of thought is that the PBM businesses, the middleman business, if they take a percentage of the drug price, then this will likely drag on their profits over here. So if you don't know what a PBM does, basically they're the middleman. So they negotiate deals with the pharmaceutical companies, like for example Novo Nordisk, and then they take a portion of that profit and then they sell it at a higher price to all the insurance customers that they have over here. So United Health, for example, they have a portion of their business under Optum RX, which is their PBM portion of the business. It is currently now generating around 20% of their net income. So if Trump eliminates the middleman business and if Trump basically lowers all your drug prices, then you can see the PBM business being hurt as well, because if the PBM business, they take a percentage of the drug price itself as profits for itself, then the earnings will likely drop, and that could be bearish for this stock. But overall, if you're to consider both sides, it is overall net neutral for all these healthcare insurance companies, and that's why you're not seeing them dropping massively today as well. So Elevance Health is up today, United Health is slightly down as usual, Humana is up, CVS is up as well. So all these different healthcare insurance companies, they're not being hurt yet. Let's see what happens with this one. And hopefully United Health continues dropping so that I can continue adding into this position over here. I hope you guys have found this one useful and invest safe.